Okay, well I'd like to first of all just gauge in the room how many people have an investment property already. Hands up. Okay, quite a lot of you. And how many of you are considering buying an investment property? Right, okay, well that covers everyone. All right, so what I want to talk to you about tonight is just go through quickly some of the tax implications and common questions that I have asked every week, really. Lots of people are very interested in rental properties. So, having made a very big decision to invest in a property, you want to make sure that you look after it very well. And you need to decide whether you're going to have an agent to manage that or whether you're going to do it yourself. Sometimes you might be quite a long way away from your property. People buy properties interstate, so it's a good idea to have an agent manage it. But equally, if you've got the time and the inclination, you can do it yourself. So if you decide on having an agent, they'll go through the painful task of advertising for the tenants and interviewing them. In the past I have done this myself. It's not a very enjoyable task, so they will work out who are the best selection of tenants for you. They'll also act as a go-between between you and the tenant. So again, if there's questions or there's some contentious issues, if the tenant is not easy to get on with, far better to let the agent handle that than becoming embroiled in it yourself. They can also access previous rental history if there is some, so that you can sort of cover off the parts of your tenants that you may not have in your property. And they'll carry out the inspections to make sure that the property is being looked after and also to be on top of any repairs or maintenance that might need to be done. And they'll deal with all the legalities, and they'll draw up the tenancy agreement, do the condition report and handle the bond for you. One of the hints that I found very valuable is prior to having a tenant in your property, find your camera and go and take photos of every room of the house, inside and out, or taking particular note of any defects that might exist already, just so that there's no argument about any repairs that might need to be done later. So the agent, of course, will charge you a fee, but this is tax deductible. They will give you an annual summary which will show the amount of rent that you've received and also their charges that they've taken out in the commission. So what happens to the rent and also the expenses? I have people that come to me from time to time with great ideas and say, well look, my wife is not working, so I want to put all the rent in her name. I'm working, I'm the one paying the expenses, so I'll claim all of the tax deductions. That's not how it works. You have to divide it between the actual legal owners of the property. So commonly it's 50-50, let's say it's a husband and wife, 50% of the income and expense goes in one, and 50% in the other. So you need to give a little bit of thought to that before actually entering into the contract, because if it's going to be a short-term thing and what you're looking for is to be able to maximise the tax deductibility of the negative gearing, you want to of course put that in the income, the highest income earning person. If there's a spouse that's not earning any income, some of these losses can be wasted. But then you need to remember at the other end of the scale, when you're selling the property, that higher income earning person will be paying more capital gains tax, and I'll go into that in more detail. So yes, the 50-50 split could be wasted on an owner. I had several clients who there's more than two people involved in the property. We have clients there's three sisters, so they go share equally, 1/3 of the income, 1/3 of the expenses, but they all have their own borrowings, and so they claim 100% of the interest on their mortgage that they've contributed. So, what expenses can I claim? So the agent's fees that we've just talked about, advertising for tenants. If you do it through an agent, the agent will charge you the advertising. If you do it yourself, of course, you'll claim those fees. Body corporate fees. If you are involved in units or block of flats, for example, there will be a common area and you'll form a body corporate. Body corporate fees often incorporate the insurance and perhaps gardening and repairs and maintenance. Borrowing costs is one that people often miss out on. So the borrowing costs are the costs of obtaining the funds to buy the property. So you can claim things such as the establishment fee that the bank or the lender will often charge you. If you're a little bit short on your deposit, sometimes you'll be charged mortgage insurance. You can claim that as well, part of your borrowing costs. You might get a valuer to do a sworn valuation, those sorts of things. If those costs total more than $100, which they generally do, you have to write them off over 5 years, so claiming 20% a year. Cleaning, of course, self-explanatory. You might have to have the carpets cleaned or a commercial cleaner in. Electricity and gas also missed out by a few people. Often there's a bit of a crossover time. Perhaps when you bought the property you have the power put on before the tenants have actually arrived, and also in between tenants. Gardening, one to be a little bit careful of. Of course, if you've got someone coming in to mow the lawns, you can pay them, that's fine. But if you're looking at an overhaul and a backyard blitz type of thing, that's something that is a capital cost and not written off immediately. Insurance. Of course, you will be aware of insuring the property. The contents insurance will be up to the tenant, but the insurance of the property is very important, and there's a product known as landlord's insurance, something which you'll be familiar with. Landlord's insurance will guard against loss of rent, damage by tenants, and also visitors of the tenants, as long as that's in your agreement. Something to be make sure that you have. Interest on the mortgage, we've talked about. Land tax, some of you may be having been charged land tax. Lots of people seem to skate under the radar of land tax. You don't pay land tax on your principal residence, so the house that you live in, but if you have more than one investment property and the total is worth more than $250,000, you will be charged land tax by the State Revenue Office. The current calculation is if your property is between $275,000 and $600,000, I think you're charged about $275 plus 2.2% of the value. Stationery and postage, not very exciting, but deductible. Legal expenses, if you have a tenant that, for whatever reason, you're having issues with and a solicitor becomes involved, you can claim those. These are not the legal costs of buying or selling the property, but once the tenant's in. Pest control, hopefully you don't find out the house you bought is full of termites or has bees' nests in there. Quantity surveyors' fees. I thought we were going to have a quantity surveyor here tonight, but I think he's running late. I will spend a bit more time on that shortly. Repairs and maintenance, also a bit of an arguable one. There is a difference between a repair and a replacement. So the tenant's dog runs through the fence and a few palings break, that's a repair. The fence is falling down, you decide with your neighbour that we need a new fence, that's a replacement. So a replacement is a capital item. It can be claimed, but we claim via depreciation, so it's a bit of a slower process. Same as the hot water service, the element needs repairing, replacing, you can claim that as a tax deduction. If you need a whole new hot water service, you claim that as a capital item and claim depreciation on it. Travel to inspect the property, you're entitled to claim the number of kilometres that you do going to the property to inspect it, to actually carry out repairs. Some people go there and physically collect the rent. This is not a drive-by on the way to work, and neither is it packing up the family and going to Queensland to Waterworld and driving past your Queensland unit. Council and water rates, pretty self-explanatory. Often when you're purchasing the property, there will be a bit of a divvy up between some council and some water rates, so we'd like to take that information from the settlement statement and make sure we claim everything in the year that you bought it. So the costs of purchasing the property. You can't claim these immediately, but you can claim at a later date conveyancing legal costs, any advertising expenses, stamp duty to purchase the property, which is often a big chunk, and they're taken into account when you sell the property to help reduce the capital gain. So on the home that you live in all the time, that's your principal residence, there's no capital gain, you can buy it and sell it and buy it and sell it. But when you have an investment property, the government would like to share in your good fortune and take some of the profit that you make and charge you tax on it. So the capital gains tax is the difference between what you buy the property for and what you sell it for, so that profit in between. But we reduce this down to the bare minimum by taking into account the original price that you bought it for, adding on the stamp duty that you were charged, any agents' costs, legal fees when you bought it and also when you sold it, and any capital improvements. So you might have done a renovation during the time that you've had it, so we add that on as well. And provided you've owned that for more than 12 months, whatever that profit ends up being, we then take a 50% off, and then you pay tax on the balance of that. So a quick example, Hugo and Zara have just sold their rental property that they bought. They've sold it for $375, they bought it for $200,000, so they've made $175,000 capital gain. They also paid stamp duty when they bought it, so we take that off. They had legal fees when they bought it and also when they sold it, $2,000. The agent charged them $12,000 to sell it, so they have a profit of $154,000. So it's come down from $175,000 to $154,000. They've held it for 3 years, so we take off 50%, and then they both declare 50% of that in their tax returns and pay tax at whatever the rate is that they're paying in the year, commonly 31.5 cents on the dollar. Now the quantity survey report, again a little known fact. When you purchase the property, let's say in Hugo and Zara's case, they purchased the property for $200,000. That includes the land value. The quantity surveyor will tell you the value of the bricks and mortar of the building, and also the value of the fixtures and fittings that are inside, so things like the carpet, the stove, the curtains, the hot water service. They will then, so the quantity surveyor needs to actually go in the building, go inside and inspect it. We'll discuss with you when you bought it, how much you paid for it, etc. And we'll give you a report. I know the reports that we get generally from Geelong quantity surveyors are 10 years in length, so they will divide these costs over 10 years, and you can claim depreciation on these items each year. So the cost of preparing the report is tax deductible, as is the wear and tear and the ageing of the building whilst you have tenants in there. So that's the end of my very brief outline. Would anyone like to ask any questions? And I'm happy to talk in more detail with you one-on-one if you'd like to. Have you got any questions before I hand it over to Tony? Yes.
If you haven't, if you've owned property for a few years, can you then have one of those reports made up?
Yes, you can.
To having bought them?
Yes, you can, and that often happens because we have clients that come to us that have never heard of that. So you can have a retrospective one drawn up, or you can have it from the date that they do the inspection. And in the report, they note the date that they've done the inspection, which generally is not the same day that you bought it or the date that it's been built. So yes, you can. In terms of amending your tax returns, so if we're a few years down the track, you can only go back to 2 years and amend it. So you'd have to work out how long ago you've had it. But generally, the answer would be yes. Yes.
Just a question I'm often asked is, should you fix up a property prior to renting it out? What's your thoughts on that? Like, if you got some repairs and that to do, should you spend a few dollars and get it done? Prevent maintenance in the long term? Or?
I'm 50-50 on that as a personal thing. I would like to look after the properties that I have, and I would like my tenants to live in a property that I would enjoy living in. So yes, I would. Bearing in mind, often tenants won't look after the property the same way that you would yourself. So it needs to be practical, functional, clean, but I wouldn't go overboard in spending that. So all of the, just an extension to that, all of the costs that you have prior to the tenant going in are capital items, so you will be able to claim them, but not immediately. So again, even if there were, if you had to replace the fence or put new carpets in, you would claim depreciation on those, or they would be offset against the capital gain. Sorry, is that good first?
Just that depreciation period for the report, what's driving that? Suggested 10 years, but I've got a couple that are on 5 years. Don't you want to get that maximum depreciation early in the...
Oh, when I say 10 years, it doesn't mean that you only get 10 years worth of depreciation. The report will just show you for the next 10 years this is what you can claim. If you had a report that was prepared for 5 years, it would just mean that at the end of the 5 years you'd either have it done again, or you would, or in our case, we would extend it out for you so that you're continuing to claim it. At the end of 5 years, you generally wouldn't have exhausted all of the depreciation. Some things you might have, but generally most you wouldn't. So.
You said before, once you purchase it, if it is repairs, that's capital at the start and that's depreciated. What if it's in between tenant changes you've had to do repairs? Do they come up as expenses or capital?
Well,
like if you replace the bathroom or something?
Yeah, so if you're replacing the bathroom, regardless of whether the tenant is there or isn't there, the whole bathroom, that would be a capital cost. And look, you do hear of horror stories where tenants will kick holes in the walls and what have you. Most tenants, I don't mean to say bad things about tenants, most of them are very good, but if you did have to replace the bathroom, whether by choice or whether you had to, that's a capital cost. Yes?
Is it better to start repairing or replacing items prior to doing your depreciation costs, or is it better to do it after you've done it?
Prior to getting the report done?
Yes.
Probably better prior to getting the report done, because you'll have all of the evidence, you'll know exactly what the cost of that is, so it can all be taken into account. Not the end of the world if you have it done after the report is prepared. It just means that we've got the report as a starting point, and then anything that you bought after that, we just have to have a look at the invoice and take that into account. And that's quite common too.
Just one last one. Do you recommend landlord insurance?
I personally do. Yes, yes, I do. I just think it just covers all bases. And I'm not an insurance expert by any means, and you would have to make sure that you understood exactly what you were insured for and what you're getting for your money. I think it's very worthwhile, particularly for people that disappear in the middle of the night, and damage that's caused by them or by visitors that they have. Yes?
Say if you bought another property and decided to move into that and rent out what had been your principal residence, does that affect what you can claim on it?
In terms of
mortgages and things like that?
No, so you can, whichever place you're not living in becomes your rental property, whether you move back in or not. But the place that you're not living in, that you have external people in, whatever the costs are associated with that property, you can claim. So the mortgage on that place that you've now moved out of, tenants have moved in, you would claim that. Any repairs that need to be done.
Does that affect the capital gains if you were to do that?
To move out of your own property?
Yeah.
Yes, it does. That's a whole other subject of its own, but in a nutshell, if you have your principal residence, let's say you get a job overseas, you go over there for a few years and then you come back, provided you move back into that house within 5 or 6 years, I can't remember now which one, 6 years, there's no capital gains, but you have to physically move back in, you have to change your address, or that sort of thing, you can't fake that. And provided you haven't had another property in the meantime, there's no capital gains. I did see another hand up somewhere. Yes.
Sorry, I'll leave them hand. Would there have to be a minimum time you actually spent back in the house before you could then sell it? Like if you went away for 5 years and then 6-year period came back, you're only there for like a month or two, could you then sell with no capital gains, or would there be a certain amount of time you have to be there?
No, theoretically no. As long as you have moved back in and done all the things that an ordinary person would do in moving into the place, such as having the utilities put on in their name, changing their licence, changing their name on the electoral roll. So your intention was to stay there.
Yep.
Things happen. Sometimes you don't stay for long. Yes.
In that situation, is the capital gain only for the period that it's been rented out, or is it going right back from when you purchased it?
No, only from when you've rented it out. So if it's your principal residence, you don't have anything else, and you, let's say the same example, you stay overseas and decide not to come back, it will only be from when you've rented it out. So it's a pro rata thing. That's quite a common situation too.
So before renting it out, should you get it valued?
Yes. Yes, and often there's a big difference. That's been your family home and you've been there for quite a number of years. Quite a difference between what you bought it for and what the value is when you decide to move overseas. I saw another hand up over there. Yes.
So in that situation, and in retrospect probably should have had it done, would a bank valuation then count the new value of the property if it was done at the same time as the rental?
I have seen that done, and I have seen people take the value on their land rates notice at that time. That's often a low valuation. And also we've had people that have gone to a real estate agent and paid not for a sworn valuation but for information records that have of house values at that time. But it is very worthwhile having it done.